So that was 2007 to about 2009. Here's the bad news, in my opinion. We're going to go through this again. Because the exact same problems we had then, we have now. But instead of emanating in the US, guess where these problems are coming from? Take a guess. You. Where's the problem coming from?
So for Europe, Europe?
Of course, Europe. You have the ECB, they have negative. You realize that in Switzerland, every single bond has a negative yield all the way up to the 30-year bond. So except for the 30-year bond, every bond has a negative yield. Is everybody, who's not familiar with negative interest rates? Raise your hand. Okay, so,
Bond,
okay.
negativa räntor i alla nationella
So I'm going to go through it one more time because it's been my experience that sometimes when someone is not familiar with something, they won't raise their hand. So if you don't know what negative interest rate, and it's very difficult to understand because it's so nonsensical. So everybody knows what negative interest rates are? Everybody?
We know what it is, but we don't know what it does with the economy.
Okay, so I'm going to explain negative interest rates, but the best way to do it is explain an interest rate again. So I'm going to take out one of my business cards, which are fancy. So this is my business card, 24 karat gold, okay? I'm going to lend you, right, this $300,000 24 karat gold coin, okay? I'm going to lend it to you at 10% interest for 1 year. Now this is the quiz. How much did I say it was worth again? I'm picking up $100,000, okay? 10% interest for 1 year, straight interest. 1 year's over, you pay me back. How much are you gonna pay me? $110,000, okay? That's how banks work. That's what banks do to make money. And they've been doing that for thousands and thousands of years, okay? Now, with negative interest rates, we're going to do the same thing, but instead of 10%, we're going to charge a negative 10%. So you want to come to me and you borrow money from me, okay? I'm going to lend you $100,000. 1 year goes by, you pay me back, okay? How much do I get back? $900,000 back. I paid her to lend her money. She actually got paid to borrow money from me. Now, does that make sense to anybody? Because I'm still trying to wrap my head around it. So, when you go borrow money, you make money every time you borrow. And the lender is guaranteed to get a loss. You're guaranteed not to get money. This has nothing to do with defaulting on a loan or fraud. The contract is anybody who borrows money gets paid to borrow money. Now, with incentives like that, you can borrow money all day. Why work? We just go and take out loans, right? This is what's happening through the vast majority of Europe. Almost all of Northern Europe, France, everybody. Now, how long can you do business in the banking industry when you have to pay somebody to lend the money? When your whole business is basically lending money. How long does that last? Rhetorical question. Okay, does it last 40 years? If you had a bank, right, and you made money and you paid your salary from interest, and every time you made a loan, you guaranteed to lose money. How long do you think you stay in business? Guaranteed to lose money. So why do we have negative interest rates in Europe? Take a guess, anybody. Excuse me? How would negative interest rates stimulate? If you have a guaranteed loss when you do business, how would it stimulate the economy? Anybody know?
Make people spend more money, they say, of course, right?
Explain how.
Because if I have money, I can borrow money from you, then I can spend that money when I go to her shop and buy.
Right, but why would I lend you money if, why would I pay you to lend you money?
Well, that's the problem.
Anybody? Is that?
That's the problem. I mean, can you explain why the national banks go negative?
Okay.
Because of course it's to get the wheels spinning faster, but in the end, you have the banks that's not spinning down.
Well, the reason they're doing it is the banks are in severe trouble. Okay, a lot of banks in Europe are bust. Deutsche Bank, the German banks, Germany is supposed to be the prime economy in the EU, continental Europe. But those German banks are in a lot of trouble. Deutsche Bank is really in a lot of trouble. So what the European Central Bank is doing is they're bailing the banks out. So they tell the banks, come, we'll lend you money. But if we lend you money and we pay you interest, we're really just shoveling money to you. That's why they do negative interest rates. So that's a way of giving banks money and not having the banks give the money back. And that's cushioning the banks. The problem is, you have to realize why the banks are in trouble. And if this amount of money that you're giving them doesn't solve the problem, you're taking the can, you're kicking it down the road, but you're not really making any progress. At the same time now, because rates are negative when the banks spend, when you take out a mortgage, and the bank has to pay you to take out a mortgage, the bank's business is in trouble. So the central bank is trying to bail out the big profligate banks, as in spending money that should be spent going broke. They're trying to bail the banks out, and it's working, but the banks are now in a bind, because how do you do business and lending if you have to pay somebody to take a loan out? So it's a catch-22.